Look at NIO today. I mean, the stock is up over 77% over the past year.
It is a massive run, absolutely.
Right, but if you look at the data we pulled for today, April 15, 2026, it is flashing some major, really serious technical exhaustion signals.
Oh, definitely. The charts are screaming right now.
Yeah, so it leaves you wondering, is this an undervalued EV powerhouse finally hitting its stride? Or are you looking at a classic retail value trap just waiting to spring?
That is the million-dollar question.
Exactly. So before we jump in, make sure to hit the like button, subscribe to our YouTube channel, and leave your feedback in the comments. We really want to know where you stand on this one.
Yeah, let us know in the comments.
So our mission for this deep dive is to unpack a massive stack of recent financial data, technical charts, and Wall Street ratings to decode NIO's true momentum.
There is a lot to get through today.
There really is. Just to give you the immediate snapshot, the stock closed today at $6.43, which is down 2.28% for the session, but still holding on to a 16.91% year-to-date gain.
Yeah, but before we tear into the financials, it is crucial to state the ground rules here. We are breaking down market mechanics, data trends, and corporate fundamentals today.
Yes, very important.
This is not financial advice. We are just mapping out the institutional flows and the balance sheet realities so you have a clearer picture of, well, the forces moving this asset.
Right. And you really can't make sense of the volatile daily price swings without opening the hood.
No, you absolutely cannot.
I mean, like today's movement between $6.40 and $6.56, or that massive 52-week range of $3.34 up to $8.02.
It has been a wild ride.
Completely. Oh, and trading volume today was 39.3 million shares, which is actually running about 13% below average.
Yeah, and its beta is hovering right around 1.0, so the stock is basically moving in lockstep with the broader market volatility.
Right. But let's look at the actual engine underneath. The fiscal year 2025 and Q1 2026 numbers. Total revenue hit $12.51 billion.
Which is an 83.6% year-over-year increase. It is huge.
It is phenomenal top-line growth. And that translates to a gross profit of $1.78 billion.
But here is where the reality check comes in.
Yeah. The operating income sits at a negative $2.01 billion.
Ouch.
Right. Dragging net income to a staggering negative $2.22 billion. And diluted earnings per share are just bleeding out at roughly negative $1.
It is a lot of red ink.
To me, it is like a leaky speedboat going 100 miles an hour. You're bringing in $12 billion in sales only to lose $2 billion operating the business.
That is a great way to put it.
At what point does explosive revenue growth stop mattering if the net income stays in the basement?
Well, the disparity you were pointing out, it exposes the agonizing cost of scaling an electric vehicle empire right now.
Because it is not cheap.
No, not at all. High revenue proves that consumer demand is real. I mean, the cars are selling.
Right, people are buying them.
Exactly. And the gross profit tells us they can manufacture the actual vehicle for less than they sell it for.
Which is step one of a real business.
Right. But the bleeding happens in the operating expenses because NIO isn't just a traditional automaker.
They have that whole swapping thing.
Yes. They are attempting to build an entirely parallel infrastructure moat. Their battery as a service, or BOSS model, requires them to construct and maintain massive, capital-intensive battery swapping stations all over the globe.
Which is wild. They are essentially trying to build out the equivalent of a global gas station network while simultaneously trying to scale the cars themselves.
Exactly.
And that requires holding immense physical battery inventory at every station.
Right.
It isn't like a standard EV charging network where you plug into the grid and let the customer wait.
No, it is totally different.
They have to warehouse charge depreciating assets everywhere.
Which fundamentally alters their cash burn compared to competitors.
How so? Like, in a tangible way?
Yeah. Well, a traditional EV company builds a factory, produces a car, and sells it. NIO builds a factory, produces the car, and then commits to an ongoing capital expenditure cycle to maintain the swapping infrastructure.
I see.
Yeah, that is what makes their cars appealing in the first place, but it is expensive. The negative $2.01 billion in operating income reflects that dual mandate.
So they are spending heavily on R&D for autonomous driving tech while bleeding cash to keep those swap stations operational.
Exactly.
But, burning billions to build out that infrastructure moat is one thing. You can only burn cash if you have it to burn.
That is the big catch.
When we move from the income statement to the balance sheet, the liquidity numbers get incredibly tense.
They really do.
On paper, total assets sit at $17.8 billion, against $15.99 billion in total liabilities.
Which leaves a pretty thin margin.
Very thin. They do have a cash position of $3.73 billion. But what really caught my eye is the operating cash flow.
Oh, right.
It's sitting at a positive $427 million.
Yeah.
At first glance, generating cash from day-to-day operations feels like a massive victory for a company with a $2 billion net loss.
You just look good on the surface.
But when you look at the balance sheet leverage, it kind of feels like an illusion.
Well, positive operating cash flow is a crucial milestone, sure, but you have to look at working capital dynamics to understand it.
What do you mean by that?
Often, in a high-growth EV model, positive operating cash flow while running a massive net loss is driven by deferred revenue.
Like subscriptions.
Exactly. Money collected upfront for services, software, or battery subscriptions that hasn't been recognized on the income statement yet.
Ah, okay.
Or, frankly, by stretching out payables to suppliers. It buys them time, but it doesn't neutralize the balance sheet risk.
And the risk is the debt.
Yeah.
I mean, we are talking about a debt-to-equity ratio of 335.96%.
It is massive.
That sounds like a homeowner with 3 mortgages to pay for a luxury renovation. It's a leverage ratio around 2.08.
Yeah, and the liquidity is tight.
Very. With a current ratio of 0.98, they are technically underwater on their next 12 months of obligations.
Which is terrifying in this macro environment.
Right. It's essentially running a massive corporate operation on a high-stakes margin loan. As long as deliveries keep going up, the lenders stay quiet.
Exactly.
But if we see a macro pullback or if sales stall, that leverage goes from a growth accelerant to an immediate liquidity crisis.
Yes, it happens very fast.
How do they bridge a current ratio below 1.0 without radically diluting the shareholders?
Well, they are entirely reliant on maintaining that top-line growth to satisfy creditors. If they can't, they have to tap the capital markets again.
Which means issuing more shares.
Right. A current ratio of 0.98 means that for every dollar of debt maturing within the next year, they only have 98 cents of highly liquid assets to cover it.
Wow.
The margin for error is non-existent. If macroeconomic conditions tighten or credit markets dry up, refinancing that short-term debt becomes punitively expensive.
So that explains the massive layoffs.
Yes, the operational cost-cutting we've seen is a direct response to this liquidity squeeze.
They slashed over 10,000 jobs last year.
Yeah.
That isn't just trimming corporate fat. I mean, a headcount reduction of that magnitude is a strategic pivot to survive the debt load.
Absolutely. Slashing overhead is the only immediate lever management can pull to defend that $3.73 billion cash pile.
Right. But what's fascinating is the internal optics of those cuts when you compare them to insider activity.
Oh, the insider holding is very telling.
Right. We aren't seeing executives dumping massive blocks of their own shares.
No, they're holding tight.
Management is holding their equity while ruthlessly cutting operational burn. They are basically signaling confidence in the long-term viability, as long as they can navigate this cash crunch.
Which leads us to how the broader market is interpreting that fragile foundation.
Yeah, who is actually buying this stock right now? We talked about the retail versus institutional dynamic.
Right.
Looking at the options chain from early April, we saw directionally bullish call option flows from large institutions.
You did.
It looks like big money is betting on a run-up, but we also see everyday retail traders looking at that $6 price tag.
And that is where it gets dangerous.
Yeah, I have to ask. We see institutions buying calls, but is this a setup where retail traders see the $6 price, think it's a seal, and get trapped in the volatility?
Yes, it is the textbook definition of a value trap.
Walk us through how that works.
So the institutional flow is moderately bullish, but you have to break down how institutions utilize those call options compared to everyday traders.
Okay.
When an institution buys a massive block of calls on a highly leveraged company like NIO, they rarely take on naked directional risk.
Right, they hedge.
Exactly. They are usually executing complex delta hedging strategies. They might buy the calls to capture explosive upside from an earnings surprise, but simultaneously short the underlying stock. Or they use put spreads to protect against a liquidity event.
So they cap their downside if that 335% debt ratio suddenly implodes the stock.
Precisely.
Yeah.
But retail investors look at the historical highs, see the current $6.43 price tag, and just buy the stock outright.
They get seduced by that 77% historical gain and assume a $6 stock has been completely de-risked.
Right, and a lower share price does not equal a lower risk profile.
That is such an important point.
The retail trader absorbs the full unhedged downside. If macroeconomic headwinds hit the EV sector, the institutions will unwind their hedges and walk away with minimal damage.
While the retail trader left holding the common stock takes the brunt of the capital destruction.
Exactly.
So let's overlay the actual technical analysis to see where that pressure is building right now.
The charts are very revealing today.
Technically, the overarching trend is undeniably bullish. The stock is trading above its 20-day, 50-day, and 200-day simple moving averages.
Yes, the trend has been strong.
We have a solid floor of key support at $6.07 and a classic pivot point way down at $4.88.
Right.
But the resistance is capping the price action at $6.58, with the R3 zone up at $6.92.
And the momentum indicators are screaming that this rally is out of gas.
Yeah, let's talk about those bearish warning signals. The 14-day relative strength index is sitting between 62.8 and 63.7.
Approaching overbought.
The MACD is throwing off mixed signals, some buy indicators, but also warnings of a potential bearish crossover.
But the real alarms are the extreme overbought alerts.
Oh man, the stochastic RSI is pegged at a massive 98.7.
It is screaming exhaustion.
And the commodity channel index, the CCI, is at 176.7.
Yeah.
A stock RSI of 98.7 is like a rubber band stretched so tight it's starting to hum.
That is exactly what it looks like on the chart.
I mean, if the trend is bullish, but momentum indicators say exhaustion, which data point usually wins in the short term?
The divergence between the moving averages and the momentum oscillators is the most critical thing to watch.
Okay.
Moving averages show you where the stock has been. They confirm the buyers have been in control.
Right, it's historical.
But momentum indicators like the stock RSI hint at immediate fatigue. They measure the velocity of the current order flow.
So what happens at 98.7?
At 98.7, the upward momentum is running on fumes. Short-term weakness is highly likely because the buyers are simply running out of steam at that $6.58 resistance wall.
Everyone who wanted to buy this cycle has already bought.
Exactly. Even a slight uptick in selling volume will encounter an empty bid stack.
Meaning the price slides backward.
Yes, it slides rapidly to find new buyers. The technical setup heavily favors a short-term pullback to test that $6.07 support line.
Okay, so we have technicals demanding a pullback and a balance sheet flashing liquidity warnings.
Yeah.
Yet Wall Street seems surprisingly optimistic. Let's look at the analyst ratings.
The street is definitely looking past the immediate hurdles.
The consensus rating is currently a hold, which breaks down to 7 buys, 4 holds, and 2 sells.
With an average target price of $6.80.
Yeah, and we've seen a wave of recent upgrades in March and April.
Right, some big names.
HSBC maintained a buy with a $6.80 target. Nomura reiterated a buy at $6.60. DBS Bank calls it a moderate buy.
And Citi just raised their target to 58.60 Hong Kong dollars while keeping their buy rating.
Right, and Wall Street is anchoring a lot of this to the valuation multiples, specifically the price-to-sales ratio.
Which is incredibly low right now.
It is. NIO is currently trading at a PS ratio of just 1.14x. Estimates are split. Some say it's undervalued. Others claim it's 1.4% overvalued.
Yeah.
But to me, a PS ratio of 1.14x for a company with 83% revenue growth sounds like buying a winning lottery ticket at a discount.
Right.
Are analysts being too conservative with that $6.80 target?
Well, this brings us right back to the undervalued versus value trap debate.
How so?
A low PS ratio only makes it undervalued if they can survive their debt load long enough to become profitable.
Because the PS ratio completely ignores the debt.
Exactly. When you buy the equity, you aren't just buying a claim on that $12 billion in sales. You are absorbing the liability of the $15.99 billion debt load.
So that 1.100x multiple isn't really a discount.
No, it's a risk premium. If they are forced into a massive share offering to clear their short-term debt obligations, the resulting dilution will crush the equity value.
Regardless of how cheap the sales multiple looks today.
Yes. The debate among analysts centers entirely on whether NIO can outrun that debt.
So the firms issuing those buy ratings think they can.
Right. They are projecting that the top-line growth will eventually generate enough scale to transition the company into sustained profitability before the debt matures.
And holds and sells.
They believe the capital requirements of the buys network and the intense competition will force a restructuring or severe dilution first.
Okay, so let's map out the forward outlook. What are the best case recovery and worst case continuation scenarios?
We have to look at the timeline, short-term versus long-term.
Starting with the short-term catalysts. We have Q1 earnings approaching on June 2, 2026.
That is going to be a massive print.
Heading into that, their delivery momentum is super aggressive. March deliveries exploded by 136% year-over-year, hitting 35,486 units.
It is incredible growth.
And there is immense optimism surrounding the launch of their new flagship ES9 SUV.
Right. The delivery numbers are the strongest pillar of the bull case right now. Hitting over 35,000 units in a single month proves their manufacturing bottlenecks are largely resolved.
And consumer adoption is accelerating.
Exactly. If the ES9 launches without production hiccups and hits its margin targets, it provides a massive influx of higher margin cash flow just when their balance sheet needs it most.
Which feeds into the long-term bull case. They are targeting 40 to 50% delivery growth in 2026.
Yeah, their expansion plans are aggressive.
They are rolling out a multi-brand strategy. The ONVO brand for the mass market and the Firefly brand for the compact segment.
Right.
We also can't forget they did achieve a breakthrough, reporting their first ever quarterly net profit in Q4 of 2025.
They did, briefly.
And analysts are currently projecting full profitability by fiscal year 2028.
Yes. The multi-brand strategy is how they plan to fully monetize the manufacturing capacity and software they've spent billions developing.
So ONVO and Firefly let them target different demographics.
Exactly, without diluting the premium cachet of the core NIO brand. If those mass-market vehicles gain traction, the economies of scale will drastically reduce per-vehicle costs.
But, they touched a net profit in Q4 2025. But full profitability isn't expected until FY 2028.
2 years is an eternity in the EV market.
Can they hold their breath that long? Relying on an expansion into the mass market to save the balance sheet introduces massive execution risk.
Oh, absolutely. And that is where the bear case comes in.
Right. The 2.08 leverage ratio, the tight liquidity, and the looming threat of margin pressure from battery cost headwinds.
Margin compression is the ultimate threat here. That 0.98 current ratio leaves no room to absorb a prolonged spike in supply chain costs.
So if battery raw materials tick upward,
or if the macro environment tightens, their already thin margins will vanish. If they are forced to engage in a price war for the new ONVO brand, their path to 2028 profitability gets pushed back.
And any delay means they have to refinance that 335% debt load.
Likely at highly unfavorable terms. In that worst-case continuation lower, the stock breaks below the $6.07 support level and inevitably tests that $4.88 historical pivot.
Wow. So synthesizing the data we've pulled today leaves us looking at an incredibly tense financial standoff.
It really is on a knife's edge.
You have a company achieving spectacular 83% revenue growth, pushing out over 35,000 vehicles a month, and preparing a global multi-brand strategy.
The business is viable.
Yes, yet they are anchored by a crushing $15.99 billion liability load, terrifyingly thin short-term liquidity, and technical charts flashing extreme buyer exhaustion.
The underlying business is proving itself, but the corporate financial structure is stretched to its absolute limits. The upcoming Q1 earnings on June 2nd will be the ultimate proving ground. The market will demand proof that the record deliveries are actually translating into sustainable margin improvement.
Not just top-line vanity metrics.
Exactly.
NIO has absolutely proven they can build and sell highly desirable cars. The 136% jump in March deliveries proves that.
No doubt about it.
But with their multi-brand strategy launching soon, the real question isn't whether people will buy NIOs.
No.
It's whether NIO can afford to build them long enough to see 2028.
That is the real test.
If battery costs tick up next quarter and the debt covenants tighten, who blinks first? The institutional funds aggressively hedging their call options, or the retail traders holding the stock and hoping that $6.43 is the floor?
It is going to be fascinating to watch.
It's a brilliant machine running on a desperately short runway. Something for you to keep a close watch on is that $6.07 support level, because the next few weeks of trading volume are going to dictate the survival of this rally.
Keep your eyes on the charts.
Thank you for diving deep with us today. We will see you next time.